Hi, everyone. This is Lene Jones Jules of Jules Realty, your real estate boutique. And we are live today, Facebook Live, with the one and only Mr. Tim Maxwell of MLB Residential Lending. Today is a big day. We're talking credit. And that's a big topic. Tim, can you get us started? What do we need to know about credit when we want to buy a house? I know I work with a lot of people and we have big ideas of what we want, but somehow that credit, man, can do a whammy on a lot of us. So can you get us started on what is good credit? What is considered good credit?
Now, that is a great question, Lene, because everyone has a different idea about it. And I can tell you that out of all the years that I've been involved in this industry, which is, it's been about 30 years, I've heard all sorts of things that really is not accurate. So let's talk about credit for a second. In general. So we know that years ago, it used to be that a person's credit was determined by someone's analysis or review of your credit payment history. If you paid your credit on time, then they said that you were credit worthy. If you paid late, then they said that you weren't, but there was no way to quantify how good or bad your credit is. It was just some person's individual opinion. But the nice thing, I have to say, I was so happy in this industry when I saw that we went away from that, because that business model of analyzing a person's credit based on how one person feels could change from one person to another, depending on who looked at your credit report. Well, that's no longer the case in our industry. And it is true that still there's some individual subjectivity involved in analyzing a person's credit. But for the most part, it's based on your credit score. So if you have the right credit score, then you may qualify for a particular loan program. But if your credit score is too low, you won't. But the score alone is not the only factor. But let's just talk about the score for a second. Most individuals in our industry realize that a credit score below 620 is just not doable for most programs. And that's not exactly true, but it's predominantly true, but not always. So for example, with certain lenders, you could have a credit score of 620 and your credit score will still be too low to be able to get a mortgage with them. Some require a minimum credit score of 640. Some may say, 650 might be their minimum. Each lender could establish what their own level of acceptance is with regards to your score. Now, other lenders, but in general, we should say the agencies that govern lending in this country really determine what the minimum acceptable credit score is. So, for example, with regards to most conventional loan programs, and we're talking about loan programs that are sponsored by Fannie Mae or Freddie Mac, those are our country's major agencies that govern the underwriting guidelines for conventional mortgage loans. Well, the minimum credit score that you can have to apply for one of those programs is 620. So you got to have a 620 credit score with them. But it's possible, by the way, to have a 700 credit score and still not be able to qualify based on your credit, because there are other factors that we look at, not just the number, but certainly the credit score itself is a good place to start. If your credit score is too low, no matter what your other circumstances are, there's a good chance that you will not be able to even apply for a loan with those programs. So, but that's with conventional loans. But we also know that in our industry, there is more than just one type of loan program that you can apply for. So most people, if your credit is not that great, might consider the government loan program, such as the VA loan or the USDA loan or the FHA loan, which is the most popular, right? Now with FHA, there is no minimum accepted credit score. FHA doesn't post a minimum. So some people say, oh, yeah, you got to have a credit score of at least 620 in order to be able to get an FHA loan. It's not true. In fact, we have closed loans with credit scores far below 620, and still our client was happy and made out just fine. But truly, you should target 620 as a goal if your credit score is lower than that. But honestly, you really need to have a credit score of 700 or 680 to really have the best result in terms of getting the best terms on your new loan. So let's just talk for a second about the credit bureaus and agencies themselves. Now, most of us realize that our credit is made up or is evaluated based on the criteria that's we receive from 3 different agencies: an Equifax score, TransUnion, right, or Experian score. So either one of those 3 agencies, each one of them is going to give you a different number. But the way the mortgage industry works is that they will look at all 3 scores. Every lender works the same way. They'll look at all 3 scores: Equifax, Experian, and TransUnion. And then whoever has the highest score will be considered. Whichever agency comes up with the lowest score will be considered. But really, it's the one that's in the middle. So if you have a credit score, for example, one agency of 700, maybe another agency will give you 650, another agency will give you 600. It's the 650 score that drives the underwriter's review of your file. So if your middle score is 620 or better, you're going to be able to at least apply for a conventional loan program. But if your middle score is less, you won't. So you can have, for example, a credit score of 800, a credit score of 850, and a credit score of, or we shouldn't say it like that. Let's say a credit score of 800, a credit score of 600, and then maybe a credit score of 500, which you'll never have a spread that wide. But let's just for argument's sake, your credit application will be based on the 600 credit score, the one that's in the middle, not the 800, but not the lowest one, but the one that's in the middle. So that's the basic guideline that a lender will consider when they're trying to determine whether or not you are credit worthy or not. But I said that there are other things that determine whether you are credit worthy, not just the score. So, for example, you could have a credit score of, let's say, 680, let's just say, or even 700, and not credit qualify. And the reason that you wouldn't, for example, might be because maybe perhaps in the last 12 months, you've had a late mortgage payment that shows up on your credit report. Mm-hmm. Sometimes we have people that have late rental payments that show up on your credit report, even though those are not normally reported to the credit agencies. But, we're living in a time now where landlords are becoming more sophisticated. It's possible to have some information from your rental payment history show up on your credit report. So we really want to make sure that we're doing our best to make our rent and our mortgage payments on time. So if you currently own a home and you've been late within the last 12 payments, within the last 12 months, no matter how good your credit score is, you cannot get a new mortgage, either not with conventional or government loans, without a really great explanation. So I should qualify that, because somebody's going to say, oh, yes, you can have a late payment within the last 12 months. That is true. If, for example, you have an excuse like, oh, I was in a coma and I couldn't make my payment, but it would have to be some drastic explanation like that.
This makes me think about over the past 12 months, we were in a pandemic. People had did things with their mortgage company so that they didn't have to pay. They pushed it back. They skipped a few payments. Now, is that going to impact, if they need to do something, or does that impact?
That is a really, really, really great question, because that comes up often. Mm-hmm. So the good thing is that because of the pandemic, we've been given a reprieve or a pass, somebody would say. So you could, as long as you took advantage of the forbearance and you didn't make your mortgage payment, we're not going to penalize you for that. The government has determined or dictated that we cannot penalize a consumer that apply for a forbearance. However, you should know that if you are currently in forbearance, you need to get out of the forbearance in order to be able to qualify for a new loan. You can't just say, oh, I'm still in forbearance. I got another couple of months to pay, but I would like to get a new mortgage. No, you have to be out of the forbearance in order to qualify for your new loan.
That middle number is kind of shaky. What do we do to repair that? And how quickly can that be done?
That's a good question too, because typically that's what I'm dealing with on a day-to-day basis. Now, it is true. I talk to so many customers who apply for assistance through credit repair agencies, and some of them are okay. But the difficulty that I run into with customers who have tried to get their credit repaired through a credit repair agency is that the standard process for repairing your credit is to dispute all the derogatory items that are on your credit report. There's a problem with that for a mortgage lender. The problem is that if you have even one credit account disputed on your credit report, we can't give you a mortgage of any type. So you would have to pay it off unless it was a zero balance on the for that particular credit trade line. If you paid it off and you disputed it, we're fine. We won't have any trouble with that. But if you dispute any other accounts that are on your credit that have an outstanding balance, it's going to show up on your report as being disputed. The government tells all lenders that they have to stop until that disputed account is resolved with the creditor. So it's generally not a great idea to dispute items on your credit report. It's better just to contact the creditor and work it out with them. You can settle it for less than the amount that's owed. That'll be okay. But disputing it doesn't fix the problem. It only guarantees that you'll never buy a house until that dispute is resolved. Most of the times we're disputing accounts on our credit report that has very little impact on your ability to get a mortgage. So don't waste time disputing accounts unless you talk to me about it, and I can tell you which ones you can dispute and which ones you can't. But let's talk about what we actually do to help you to improve your credit. Well, what we do is we're not just trying to, get you a better credit score. We're analyzing your entire credit report from top to bottom to make sure that every aspect of it conforms with agency guidelines, agency credit guidelines. We're going to get your credit score up if need be, and we're going to discuss with you the items that are showing up on your credit report that may affect you negatively during the underwriting process. And what we use that helps us with this process is a computer program that actually analyzes the credit from all three credit bureaus. And we get suggestions from those credit agencies that tell us if you did this, or if you paid that down, or if you remove this, this is what your credit score is going to be. So once we do the computerized analysis, what we'll do is we'll send you a report that's going to tell you exactly what you need to do in order to get your credit score up. And it's going to give you a pretty good, fairly accurate number of what your credit is going to be once you've taken those steps. And to answer your question with regards to how long it takes, actually, in many cases, we can affect the credit change dramatically in only 10 to 15 days, or sometimes less. And it just depends on when we analyze the credit and when the consumer actually takes action on the things that we recommend that they do. Here's an example, right? And in this case, we have Barbara Lang, and it said, you see this is an copy of an email that we've sent out, and it says clearly here that we found a way to reach 660 or better, 660 or better. What is the likelihood of this happening? We're telling Barbara that it's going to be 95% likelihood of it happening. What is she going to need in order to be able to get that credit score to 660? It says over here, it says over here, was $1,800. I don't know what happened there. Oh, I got this back off. Yeah, $1,800 Barbara would have to spend in order to get her credit score up to 660. So I don't recall exactly what Barbara's credit score was, but it might have been in the 500s or something, let's just say. And it gives her exactly it tells her exactly what she needs to do in order to make that happen. So for example, it says in this case, J.C. Penney card need to be paid down from $3,900 to $3,500. Her other J.C. Penney card need to be paid from $6,900 down to $6,200. Bank of America from $700 paid down to $0. And then it says over here, it says avoid other changes, tells you what to do, what not to do in order to not have your credit score go back in the other direction. And in this case, we even gave her an additional direction on something that she needed to pay off that didn't even show up on the report. Now, we know that once we send out this computerized credit analysis to our customer, their credit is going to be good enough to be able to purchase a home. And let's say that it's today that Barbara took care of all of these things. She paid them all off. Typically, the creditors report the changes that you've made to your credit accounts at the end of the month. Some have different dates to report. So, for example, kind of regularly, I see Capital One will report on the 6th or 7th day of the month, for example. Other creditors have different other days, but majority report at the end of the month. So that means that if I spoke to a customer today and we analyzed their credit today and they paid off everything today, and then usually by next week, we would be ready to actually move forward with the client purchasing a home. So basically, that's the way it works. We run the customer's information through the computer. It analyzes the results. It tells us what each one of the bureaus are recommending that they do in order to get their credit score to where we need it. We give them those action points. And if they take those steps, we're going to have a customer who today can't qualify, next week can. Mm-hmm. It's going to happen that fast. Now, sometimes the creditors actually slow up the process for us. And the problem is that once the customer takes the steps that we recommend with regards to their credit, we have to wait for the creditor to actually post that change at the credit bureau level. Once they do, then we're going to see new scores. But sometimes they might be a little slow. So, for example, let's say that their normal review time for their credit accounts might be the 20th of the month. Well, in this case, today is the 28th. They're going to have to wait almost another 30 days before the creditor posts the adjustment that they made. So that is something that can slow down the process. But even so, still, we're talking 30, 45 days, at the longest in order to get this credit situation straightened out.
Mm-hmm. That's good information, Tim. So what I'm seeing, hearing you say, and I'm thinking about people that I've worked with in the past who know they have bad credit, want to buy a house, and they immediately think, well, let me go to a credit repair person and pay all this money and get my credit worked on. But what I'm hearing is we could go to you directly and you can give us those tools. Is that what I'm hearing?
Exactly. I prefer to do it that way because that way we're not wasting a lot of time. You go to the credit repair agency, they go through that dispute process. They really muck up your credit report with all these dispute remarks on your report, and it becomes very troublesome and expensive to remove all of those remarks off of your credit report. If you're really serious about buying a house, the best thing to do is to give me a call. Let's take a look at your credit. We're going to analyze the credit, and we're going to let you know exactly what you need to do in order to make this happen. And by the way, we don't charge anything for the service. But let's be clear, we are not a credit repair agency, and we are not in the business of repairing credit. We're in the business of making mortgage loans. It just so happens that during that process, we may have to make some recommendations to the consumer about what they might do in order to be able to improve their credit. And by the way, we're pretty much 100% successful at making this work. Mm-hmm. So it's not, and there's always a level of or at least a chance that maybe they might make some adjustments and it don't work out the way they would like it to. But that's because our credit histories are, it's very fluid. I should say, because our credit items are constantly changing. Even though you did paid one thing, somebody else was reporting something else about something else you're doing. So we have very fluid credit histories or activity that's going on with us every single day. So sometimes we could say, pay this and pay that, and you're going to have that happen, and then they do it, but something else goes wrong, and then it kind of slows the process down a little bit.
We had somebody who was excited about buying a house, went through the whole process, getting ready to go to the closing, and they decided they wanted to buy a washer and dryer to move into their house,
Oh, yeah.
And
Bad. That was a mistake.
Mm-hmm.
So this is what happens. There are some things that you do that have a negative impact on your credit. One thing is just applying for new credit. If you're applying for new credit, just know that new credit items tend to have a negative impact on your score. So no matter what your score is today, if you open up a new credit account, or if you go car shopping and they're checking your credit, it is going to hurt your credit score. It's going to create a problem. I had a case once where I qualified a customer to purchase a home, and her credit scores were over 700. She was excited. In fact, she was selling her home to go buy another one. Well, in the meantime, she went out and a bunch of people had checked her credit, and it took her about maybe a month or two to sell her home. But by the time she got back to me, she had all these inquiries on the credit report. Her credit score went from 700s down into the 500 area. Wow. Because of all of these inquiries. So one of the things that you don't want to have is a bunch of inquiries on your credit report. And that's why at MLB, we tend not to check your credit report for more than once every 180 days. We keep it, we're not checking your credit over and over and over again. We're not going to do that. The only time that we're going to check your credit report in a shorter period of time is if you've taken the action that we've asked you to take. It's already been updated on our credit report. We'll do what we call a soft pull, where we'll look at your credit report and it won't show up as an inquiry or anything like that. That protects the consumer's credit. And then if everything looks right, then we'll pull a regular credit report and put them in the house, get them the loan. And I just thought of one thing that I think everyone should know, and this comes up almost every day. If you were to go on to Credit Karma or any one of those sites and check your credit, or even if you went to Equifax, TransUnion, or Experian and got a credit score, most of the time, those credit scores are not the scores that lenders are using. The scores that we use are specific for the industry, for creditors, right? The consumer credit score is going to show up as a higher number. But the credit scores that creditors use to evaluate your credit, those are going to be evaluated with much more stringent criteria. So the scores tend to come out lower. So don't be misled when you look at your credit score that you've gotten from any one of those types of companies. They do represent great value, but I'm just saying that you gotta get the mortgage credit scores from the credit agencies or from us when we evaluate your credit.
Can you leave us all your information, how we can get in contact with you?
Absolutely. Timothy Maxwell is my name. I am a branch manager for MLB Residential Lending. And my telephone number is 732-433-6040. 732-433-6040. That's my cell phone. You can call me directly.
Thanks for watching. If you like this video and you want to see more like it, subscribe to Jules Realty Boutique on YouTube. Follow us on Instagram. And on Fridays around the noon hour, we have our Real Estate Roundtable live on Facebook. Great real estate tips every Friday around the noon hour. So connect with us. We look forward to connecting with you. It's Jules Realty Boutique. See ya.